When you retire, the paychecks stop, but the bills don't. And suddenly you're forced to live off of a portfolio that was never designed to meet your monthly income goals. This is a problem that I have seen retirees face in the last 2 decades of my career. And if there's one thing that I've learned, your goal should not be to just retire, but your goal should be to retire with a reliable income source. By the end of this video, you will learn about investment options that can help you seek to generate monthly income. In retirement, a big portfolio can look great on paper, but unless it can pay your bills like a paycheck, you won't feel like you've reached financial freedom. About 61% of retirees say that their biggest financial regret is not having a steady stream of income in retirement. You could have $1 million portfolio, but if that portfolio doesn't send you a steady stream of income, you could end up improvising. Meanwhile, a monthly income may help bring structure and replace uncertainty with confidence. Psychologically, it can help to create peace of mind. And financially, it can help give you control to help align your income with your lifestyle and goals. And that matters more than you may think. But traditional retirement accounts like IRAs and 401ks aren't typically built for monthly income. They're built for accumulation and growth. You spend decades contributing to them only to discover that these accounts don't send you a monthly paycheck. Then you're left trying to figure out how much to withdraw, when to make those withdrawals, and how long it'll last. So how do you turn your savings into a paycheck that matches your monthly lifestyle? Well, that is what I will discuss next. In my opinion, monthly income isn't about getting that from just one source. I believe that you need a mix. Some options offer safety, others offer yield. The key is to understand how to combine them in order to create steady cash flow. Start with your safety net. Your savings account is your financial cushion. It pays monthly interest, it's usually FDIC insured, and you can access it at any time. However, it's not an investment. Even a high-yield savings account might not beat inflation, but it keeps you from selling your actual investments at the wrong time. When you need a bit more yield and you know that you won't touch the money for a while, then you can look at something like CDs. They offer predictable returns in exchange for locking in your cash for a period of time. You usually will be in a CD from anywhere from a few months to potentially a few years. The loss of flexibility is the trade-off. But for short-term goals or known expenses, CDs are a way of securing income without taking on a lot of risk. Now we're getting into true income territory. Bonds don't grab headlines, but they can be a very powerful tool. Bonds are the foundation for many retirees because they are designed to pay you interest in turn for lending money to governments or corporations. So with a bond ladder or a bond fund, you can also create an income stream. If you're looking for income with upside potential, then dividend-paying stocks have the opportunity to provide both. But not all dividends are safe. The real value lies in investing in dividend-paying stocks that will pay strong, consistent dividends from financially sound companies. Next, if you like the idea of real estate income without managing properties, then REITs can fit the bill. These companies own and operate real estate, anything from commercial buildings to apartment complex, and they pass on 90% of the income to shareholders. Many REITs strive to pay monthly and give you real estate exposure, but the liquidity of a stock. And unlike owning property, you have no leaky roofs to fix. Then if you want to go hands-on directly, then owning property can offer strong monthly income. This income can be tax advantaged and have long-term growth potential. But make no mistake, because this is active investing. Between maintenance, tenants, and vacancy, it does take time, money, and skill. Either treat it like a proper business or hire someone who can turn it into one of your most powerful income sources. Now, coming to annuities, they can look complex. You give money to an insurance company, and in turn, they will pay you a monthly amount for a fixed period of time, sometimes life. Immediate annuities will start paying right away, while deferred annuities will start paying you later. Either way, you're locking in a stream of monthly income payments. But know what you're buying. There's several types of annuities, some good, some bad. And so some of these annuities can have very high fees. And once you're committed, you are locked in. Finally, business is the highest reward strategy here. More than 50% of small business owners from ages 55 to 64 rely on income from their business as part of their retirement plan. Whether you start your own venture or invest in someone else's, business ownership can provide a steady monthly stream of income through salary or dividends. But it comes with high risk and high involvement because even ventures like franchises or partnerships demand careful planning. Still, a well-run business can outperform almost any other asset, but as long as you know what you're getting into. But no single investment will carry your retirement safely and sustainably. You need something more. Savings accounts are safe, but weak on returns. Dividends can be great for growth and income, but markets can wobble. And real estate is high reward, but high maintenance as well. But if you stack them together, then something powerful may happen. This is how you start to build in layers. Your safety layer is your foundation. This is where you place assets that don't flinch under pressure. Consider high yield savings, short-term CDs, or maybe a fixed annuity. They're not flashy, but they're always there, liquid and dependable. This layer is about preserving access, not chasing returns. Above that sits your growth and income layer. So these are your dividend paying stocks. These are your bond ladders. Maybe there's a REIT or two. This layer does major work and seeks to pay you consistently while also growing with you. The key here is balance. And then there's the high involvement layer, which includes business ownership and rental property. It's not for everyone, but if you have the skill, the capital, and the mindset, then this layer can outperform. Each of these investment options is vulnerable on its own, but together you may be able to create an income rhythm that is hard to break. Because diversification is not a buzzword here, it truly helps to manage volatility. When your income comes from multiple sources, it's unlikely that a single risk can shake your entire retirement. That can help to build real financial durability. Now let's move to how you keep it. Even with multiple income sources and strategies, you can still lose money by pulling it out the wrong way. I've seen some retirees slip badly with their withdrawal strategy. I'll explain how. Say you have money in 3 types of accounts: a traditional IRA, a Roth IRA, and a brokerage account. You withdraw from your traditional IRA first. By doing so, you push yourself into a higher tax bracket and potentially trigger higher Medicare premiums. Touch the Roth IRA too early and lose out on tax-free growth. If you ignore your brokerage account, you could be missing out on favorable capital gains tax treatment. The order and timing matter, and it all ties back to your monthly income plan because it's about when and from where you take your money. And that gets even more critical once RMDs kick in at age 73. If you're not managing your income streams with taxes in mind, then those required mandatory distributions could force you to pay more in taxes than you needed to and potentially take out more than you needed to as well. This is where smart retirees play offense. They use tax buckets to diversify their money. They try to match their income needs to tax strategy. They lean on brokerage accounts for capital gains instead of pulling out of a different account and paying ordinary income. And they stagger withdrawals across accounts to smooth their tax bill over time. A 2022 study showed that retirees who use a coordinated withdrawal strategy could extend their portfolio life by over 7 years. Just by managing order of withdrawals in tax brackets. Remember, monthly income is only one side of the equation. The other is making sure that you don't give too much of it back in taxes. And then for most retirees, Social Security is the only inflation-adjusted guaranteed source of income that they will receive in retirement. You treat it as an afterthought, something that you just turn on in the late 60s without a real strategy. But that is a mistake. Social Security is more than a benefit. It's a predictable monthly paycheck. and it can be the foundation of your income plan. However, like any income source, timing is everything. If you claim it at 62, then you lock in a smaller check, potentially up to 30% less than if you had claimed it at your full retirement age. But if you delay it past your full retirement age, every year you wait gains you 8% more and guaranteed income. And that check increases with inflation. Year after year, your payment adjusts to help you maintain purchasing power. It's a rare feature that most income streams don't have. So the smart move is if your portfolio or your rental income can cover your expenses, your essential expenses that is, then delaying Social Security can turn into your strongest hedge against inflation. In case you do need the income earlier, coordinating Social Security with your other sources of income and your tax bracket is key. In other words, don't guess. Integrate it and use it to stabilize your monthly cash flow and build from there. If you still find this whole monthly income pathway confusing, then I'll just explain with an example. Suppose you're 65 with $900,000 saved. It's split between a 401k, a Roth IRA, and a brokerage account. You also have rental property paid off that brings in $1,500 a month. And your estimated Social Security at age 67 is $2,200 a month. At first glance, that might just sound like a list of assets, but with careful planning, you can turn this into a monthly paycheck. I'll show you how. Your rental income is $1,500 a month, steady and dependable. Your brokerage account is invested in dividend-paying stocks, and a bond ladder, together generating around $800 a month in interest and dividends. To cover your remaining needs, you would draw about $1,200 a month from your 401k. That's already about $3,500 a month. And once you hit 67, your Social Security kicks in with another $2,200 a month, bringing your total to $5,700. Meanwhile, your Roth IRA sits untouched. It's a flexible reserve for bigger expenses, future travel, or healthcare cost. This is wealth coordination. When markets dip, you reduce portfolio withdrawals. And when taxes rise, you could always lean on your Roth. Because your income comes from different places, that's how you stop guessing and start living. Hence, the confidence doesn't just come from having more money. It comes from knowing exactly that your money is doing what it is supposed to be doing. Remember, retirement is the lifestyle that you've earned. So if you've been saving and investing for years, now is the time to shift from accumulation to distribution with clarity and a plan that strives to provide you with monthly income that you can count on. If you want help building that plan that customizes to your savings, your taxes, and your timeline, then let's talk. Click the link in the description to schedule your complimentary session. This is what I do every day with clients who want to retire with confidence and stay in control. Because when your income is clear, your retirement is calm, and that is exactly how it should feel. Thank you so much for watching. And if you enjoyed this video, then I think you would enjoy this video on a step-by-step guide on how to create tax-free income in your retirement. As always, I hope you have a lovely day, and I hope to see you in the next video.